Welcome to our financial education series. Today, we're exploring a fundamental concept. What is a credit card balance? A credit card balance is the total amount of money you owe to the credit card company. This balance is a result of your purchases, cash advances, balance transfers, fees, and interest charges. Every time you use your credit card, the amount spent is added to your balance. It's crucial to understand that your credit card balance is not static. It fluctuates with your spending and payments. This means that every purchase, payment, or additional charge alters the balance. For example, if you buy a new laptop for $1,000, your balance increases by that amount. Conversely, making a payment of $300 reduces your balance by the same amount. Additionally, if you incur a late payment fee of $25, this too will add to your balance, demonstrating how various transactions impact the total amount you owe. Interest is applied to your balance if you don't pay off the full amount by the due date. This means that any remaining balance after the payment due date will incur interest charges. For instance, if your balance is $1,000 and you only pay $500 by the due date, interest will be calculated on the remaining $500. The interest rate depends on your card's terms. So, if your card has an annual percentage rate, April, of 20%, the monthly interest on the unpaid balance would add to your total owed, increasing your next statement's balance. Your credit card statement, issued monthly, details your current balance and minimum payment required. Maintaining a high balance can affect your credit score negatively, as it reflects your credit utilization ratio. The credit utilization ratio is the percentage of your available credit that you are using. For example, if you have a credit card with a $10,000 limit and a balance of $5,000, your credit utilization ratio is 50%. Generally, it's recommended to keep this ratio below 30% to maintain a good credit score. High utilization suggests to lenders that you might be overextending yourself financially, which can lead to a decrease in your credit score. Reducing your balance not only improves your credit utilization ratio but also positively impacts your overall credit health. To manage your finances effectively, it's advised to keep your credit card balance low. Paying more than the minimum payment each month can help reduce your balance and save on interest. In summary, your credit card balance is a key indicator of your financial health and credit management. Stay informed and manage your credit wisely to maintain a good financial standing. Thank you for joining us. Stay tuned for more insights into personal finance management.